Hi, this is Harry Margolis with Margolis Bloom and D'Agostino here today to talk about capital gain and capital gains taxes. So we'll start by talking about what capital gain is. It is the difference between the selling price for property and the basis. So if you sell something for $750,000 and has a basis of $250,000, you'll have $500,000 of gain. And this applies to all properties. So it applies to real estate, stocks, interest in LLCs, valuables such as jewelry, behold gold, whether on an exchange or in bullion form, or antiques. All that is, if you sell it, you can have tax on capital gains, assuming it went up in value. So the basis on which you calculate the gain starts as the purchase price of the property. Again, whether it's a house or other properties. So in our example, we're talking about a house that cost $250,000 when you purchased it. That starts out as the basis, but there's certain adjustments to basis. And the first, which could apply to real estate, is if you make improvements to the property, then that gets added to the basis. So if you bought the house for $250,000 and then you added a new kitchen in and that cost $100,000, then your new basis is $350,000. So maintenance costs don't count. Those are improvements. So if you replace or if you fix I think replacing the roof, because it might be a little bit of a gray area now that I mention it, but really it's maintenance, so it should not be added to basis. If you paint the walls, that's not added to basis. Any maintenance items don't get added to basis. But if you replace the kitchen, if you add an addition, if you erect a garage, all the costs of that get added to basis. And the question is just keep, or the advice is really keep good records, because you may be selling the house decades in the future, and it's a little hard sometimes to reconstruct what the investment was. So now that you have an adjusted basis, then when you sell it in that $100,000 example, you save $100,000 less will be taxed. But the biggest adjustment usually in basis is the step up in basis. So again, you purchase the price for $250,000, but if you still own that property when you die, then the basis gets adjusted to the value on your date of death. So if it's then worth $750,000, that's the new basis. And then if your heirs sell the property for $750,000, they end up with no capital gain because the basis and the selling price are the same. And usually one question that people ask is, how do we establish this new step up in basis? Well, if you're selling the property soon, the sales price is the new basis, because the basis is supposed to be fair market value, and there's no better measure of fair market value than putting the property on the market and seeing what price it will bear. So that becomes the basis, and no gain, and thus no tax on the gain. But what happens if you inherit the property 1 year and you don't sell it for 5 years or 10 years, and at that point you need to establish what the basis is, what the date of death value was, and the best way is to get an appraisal. You can get that after the fact, dating back to the date of death. You could also use Zillow values, or you shouldn't use a real estate tax assessment, because that's that's not necessarily at full market value. And you can ask a real estate agent for an opinion of value. All those you might use, but they're not going to stand up to scrutiny. So if you're ever audited, you're going to have to get a formal appraisal. Another way, this applies to fewer people, that basis is adjusted is through depreciation. So let's say rather than a home, you purchased a rental property for $250,000, and you start depreciating it to save on your income taxes. Well, that may cost you down the road, because everything that you deduct on your income taxes for depreciation also gets deducted from the basis. So if you over the years have deducted $100,000 or taken $100,000 in depreciation deductions on this $250,000 property, then it will then you'll end up with an $150,000 basis and a new and a higher tax when you sell it. Now, the tax system is really designed to help real estate investors. Some might say inordinately, because they get the benefit of this depreciation expense, which in some ways doesn't make sense to me at least, because you can also deduct the cost of what you're spending on maintenance from your income each year. And then if you don't sell it and you pass it on to your heirs, then they still get the step up in basis, and they so you have the benefit of the income tax deductions and you and the depreciation, and because of the step up in basis, they never pay capital gains taxes on it. So, but that's I guess a topic for another day. So a lot of people still have in mind. Actually, let me get to that a little later. So there's also something you should know about, which is the carryover basis. So if someone inherits property, that what we talked about is the step up in basis, but the carryover basis is if you give them the property. So if you give someone the property, they get the same basis that you had, whether it was your original $250,000 purchase price or something lower because of adjustments, or higher, I guess, because of improvements. So we often get clients who come in thinking they should transfer their house to their children, or sometimes the children come in saying their parents should transfer them the house to protect it in case they need nursing home care and want to avoid mass health estate recovery. But when we explain the tax consequences, they often agree that this probably doesn't make sense, because if you have this house that you bought for $250,000 and now it's worth $750,000, and you give it to your children and they sell it, they're going to have $500,000 of gain. But if they inherit it, they can then sell it and have no gain. So that's and the taxes on sale are certain. The risk of needing long-term care is uncertain. So you don't want to create a certain tax cost in order to protect against an uncertain mass health estate recovery claim. And on another topic would be, well, how can you have your kind of cake and eat it too? And we'll talk a little bit about the life estates and trusts in a minute. But first, what's the tax? So Massachusetts, both Massachusetts and the federal government tax capital gain. Massachusetts, on long-term capital gain, the Massachusetts tax rate is 5%. On short-term capital gain, property owned for less than a year before it's sold, is 8.5%. That's probably not going to apply to too many people, so think 5%. The federal capital gains tax rates are graduated based on the overall income of the taxpayer. And here's just a few examples of what they would be for in 2024 for single taxpayer or for married couple filing jointly. And so for people who are low income, they pay no capital gains taxes, under about $47,000 for an individual and under about $94,000, double that for a married couple. But most people are going to pay the 15% tax rate, because for a single individual, that's between $47,000 and almost $520,000, and for a married couple, that's between $94,000 and $583,000. And anything above those figures, the $518,000 and the $583,000, are going to be taxed at a 20% tax rate. So for most people, the combined capital gains tax rate between Massachusetts and federal is going to be 20%. So, but let's talk about the home. As you probably know, you can exclude $250,000 of the gain on the sale of your home. And if you're married, you can exclude 500,000 of that gain. And so that's a great tax savings for a lot of people who are selling their home. To qualify for this, you have to have owned the house or the property. It doesn't have to just be, this has to be the home to get the exclusion. So you have to have owned the home for at least 2 out of the prior 5 years. But for a married couple, you don't have to, they both don't have to have owned the house. So one of them could have owned the house, but they both lived there for 2 out of the prior 5 years. They don't have to be the same 2 years if they're not living together. But if each of them have lived there for at least 2 out of the prior 5 years, then they can exclude a full 500,000 of gain. So what happens when one spouse dies? So the joint owners of the house, and they've got a partial step up and a partial Section 121 exclusion. So let's go through an example. So let's say they purchased the property for $250,000. They made no improvements. And the first spouse dies, and at the time they died, it was worth $750,000. And then some years later, the surviving spouse decides to sell it for $1 million. So, so what's the basis? Is it the $250,000 they originally paid for it, the $750,000 on the date of death of the first spouse, or something different? And what it is really half and half of each. So you basically apply the $250,000 basis to the half of the house that was owned by the surviving spouse, and the $750,000 basis to the half of the house that was owned by the spouse who died. And the easy way to calculate this is to add those together and then divide by 2. So you add 250 and 750, you get $1 million, divide by 2, and you end up with a new basis of 500,000. Then the surviving spouse sells the property for $1 million. The basis is 500. They have capital gain of 500. They can exclude 250 of the gain, and they still have 250 that'll be subject to tax. And the tax will be about 37,500, actually about 50,000, it'll be about 37,500 for the federal tax and 12,500 for the Massachusetts tax. Now, a couple just kind of fine points on this presentation about capital gains is what about carryover basis? And this is what I was going to mention before, because the idea had been, or the law had been up until 1997, that you didn't necessarily, if you sold your home, you didn't necessarily have to, or other property for that matter, didn't necessarily have to pay the tax if you bought other property. So you could basically take your basis from your first property and apply it to the new property. So you bought your first house for $250,000, you sell it for $1 million, you buy new property for $1 million, and the basis, the $250,000 basis carries over to the new property, and you don't have to pay any tax until you sell that. But when you do sell it, say for $2 million, you're going to pay it based on the original $250,000 basis in the new property, in the first property. Well, that doesn't apply anymore. A lot of people think it still does, but it doesn't. So you can't do that anymore, except if you do something called a 1031 exchange, which is only available for commercial property, and you have to go through a whole process to do that. So, but a lot of people still think they sell their house, they buy a new house, there's no capital gain, and that's old law. It's not current law. So what about trusts? So, so revocable trusts are treated as owned by the grantor for all tax purposes. So that you get a step up in basis when the grantor of the trust dies. If the property is sold while they're still alive, you still get the $250,000 exclusion. If it's husband and wife, you get the $500,000 exclusion. Irrevocable trusts it depends on the trust, because every irrevocable trust is different and may have different tax rules. So whether you get the step up depends on how the trust is written. Most trusts, in fact, are written so that when the grantor dies, even irrevocable trust, the property gets a step up, but it's not certain. It could have been a completed gift when it was created and the property transferred into it, and in which case you wouldn't get a step up. So you'd have to look at the trust or have a tax professional look at the trust. But even if it is, even if it does get the step up, whether it gets the Section 121 $250,000 exclusion is more complicated, and it depends on various factors in terms of how the trust is written, which are a little too arcane for this presentation. But if you have an irrevocable trust and you're selling a home in it, it's best to take it to a tax professional to ask what the tax implications would be. And then what about life estates? Because life estates are often used in mass health planning. So first, when the grantor dies, the property does get a step up in basis. If it's sold while the grantor is alive, then there's a formula that the IRS uses to determine how much the proceeds go to the life tenant and how much goes to the remainderment. It's based on the life tenant's age and interest rates in effect at that time. And then the proceeds that go to the grantor do qualify for the $250,000 exclusion. The remainderment can't exclude the share going to them, so they would have to pay capital gains taxes on their share. And finally, what about joint or co-ownership? So each owner can take a $250,000 exclusion, Section 121 exclusion, if they both qualify. So again, they have to own the property and live there for at least 2 out of the previous 5 years. Again, you don't have to both have lived there at the same time. So the big difference for joint ownership and of married versus non-married couples is that married couples can get the full $500,000 exclusion without both being owners of the property. They just have to have both satisfied the living there requirement. If they're not married, they have to have both owned it and lived there. If one owner dies, you get the partial step up based on that person's ownership interest. Now, so often people say add a child's name onto their house as joint owners, and there's an argument there when that happens, when the parent dies, that the property should get the full 100% step up, because they really just put the child's name on the property to so it'll pass to them when they die, not to actually, didn't intend to give them the ownership interest at that time. And so if that's the case, if it's really been treated as the parent's house throughout their life, in some cases the child doesn't even know they have an interest in the property, you can certainly make the case to the IRS that you should get a full 100% step up. So that's a quick primer on capital gains taxes. If you go to our website at, this needs to be updated, it says margolis.com, you'll still get there. It's margolisbloom.com/resources. You will see other presentations we made, both legal guides and recordings like this on other topics, and various handouts. I also have a website called askharry.info where I answer consumer questions about estate planning. So if you have any questions, you can post them there or contact us either at firm at margolisbloom.com, or the phone number 781-705-6400. Thank you.